Francisco, the consensus is that the UAE is going to cave, everything's going to be fine, there will be some kind of an extension. What's your call, and what's the price risk?
Well, we still think the baseline is there will be a deal because there's too much at stake. And we will see an extension of the current cuts, which are just about under 8 million barrels a day, possibly 2 months, maybe even 3 months. So that's what we've built into our forecasts, and I think that's what they will do. We've heard different stories, maybe some of the Russian companies potentially pushing for an even shorter window of a month. But it's hard to tell at this point which way the group's going to come out. My sense is that they don't want prices a lot higher than $50 a barrel, which is why for next year, while we see Brent hitting 60 at some point into the summer, as gasoline demand picks up and all those vaccine stories that you've been extensively talking about start to play through with the people taking vaccine jobs over the course of the next few months, mobility recovers and prices go up. But I don't think OPEC wants prices a lot higher. They fear shale coming back too much to let that happen right now. There's too much market share at stake at the moment.
Francisco, how damaged has OPEC been by the rift between Riyadh and Abu Dhabi? How lasting will that effect be?
Well, I mean, look, I mean, Emirates and Saudi Arabia, for better or worse, are joined at the hip. They share a pretty long land border, and they've had pretty close royal families for a very long period of time. So I do think there's a little bit of tension, but ultimately something that can be ironed out. Remember, Emirates is possibly the richest country in the world. They have a huge amount of money in their sovereign wealth funds across a broad range of assets. Saudi Arabia, on the other hand, has got a very large domestic population, over 25 million people compared to just under a million Abu Dhabis, so or Emiratis. So it's a little different here. But I think they'll find a way to resolve their differences because they have a lot of interests regionally. So
let's then extrapolate the macro and put it on commodities and see where we end up. We've been talking all morning about how you have higher yields, it's the reflation trade, et cetera. Typically, that's go buy commodities thing, but it feels very much in an asymmetric situation here. What kind of commodities work, what don't? How do you structure your portfolio for next year?
Right. So we are quite constructive overall, right? We think there's a cyclical upswing coming up. We already this year, if you remember, 2020, the broad commodity complex is down, but it's mostly down because mobility has collapsed, and with it, transportation fuels, essentially oil, gasoline, diesel, crude. But if you look at the rest of the commodity complex, whether it's industrial metals, precious metals, or even agriculture, all those sectors are up year on year, Alex. And we expect those trends to continue. We just think energy is going to outperform the complex, and we think gold is likely to lag. So we were very bullish gold before because we felt the problems were building up in a huge way. The vaccines have changed that. Now we think cyclical commodities outperform, gold lags. Doesn't mean we are bearish gold. Because, gosh, I mean, we're about to spend an extra $1 trillion through Congress in the U.S., and many countries are going to have to keep doing this for an extended period of time. But and we believe that now in a cyclical recovery, the right way to position your portfolio is to be long energy on a recovery in mobility, but also long, continue long on some of the industrial metals like copper, nickel, maybe even aluminum, that will benefit from a steady recovery in economic activity. So this is what's going on. Global trade, yes, it took a hit, but actually it was probably half the hit that we saw in the financial crisis. So we're looking at a pretty swift recovery, we think, in the commodity complex, with again energy possibly leading into the next 6 months.
Francisco, where do you think investors are going to get the biggest updraft from the commodities sector? Is it going to be in the commodities? Is it going to be in nickel and oil and gold and silver and copper? Or is it going to be in the equities, i.e. in the mining stocks or in the oil stocks? If you are thinking about trying to figure out where to get the best value, which one of those two buckets should you be putting money to work in?
Well, so first, let me tell you that, we cover mostly the commodity complex from our end. So I'm not an equity analyst. But the one thing to understand here is that equities are very levered bets generally on the commodity complex. And the reason I say that is because at the end of the day, a stock is an option on the underlying debt. And if we know something about these companies, is that they've taken a lot of debt. So if you think about the most distressed companies, those are the ones that are likely to benefit the most from a stock market performance, simply because they are the ones that have taken the biggest beating. So percentage-wise, if you ask me, I'd say the most distressed will be the ones that come ahead, and in the next 6 months. And some may not make it. So that's the risk here when you're dealing with the most levered companies. And remember, I think it's close to $200 billion of investment-grade debt that have been issued in the energy sector this year. And in the high-yield space, energy is about 16% of the index. Mm-hmm. So it's a complex that's taken out, or it's a sector that's taken a huge amount of debt. And again, a big rally in prices will provide a lot of relief. And we're seeing already that in the mining stocks to some extent. Energy has been lagging, though.
Right. And it's also been definitely sort of that reflation trade you were talking about. I just wanted to, it's a chart that's been circulating on Bloomberg, and it's the copper gold ratio versus the 10-year yield. And right. Typically, the 10-year yield and gold prices are going to move together, and that just isn't happening. You're seeing, copper outperform gold even though yields are moving higher. Is this a different type of cycle?
It's a unique cycle because, again, as I said before, if you think about the shock to our consumption or to our trade, right? We've had half the shock that we had in the financial crisis, even though maybe the economic impact was bigger over the course of the second quarter. The actual collapse in goods sold was probably smaller than the financial crisis. The stimulus, however, was twice as large in the case of monetary, and maybe even twice as large as well in the case of fiscal. So all of this is going to create upside pressures across the board. And also remember one thing is that the foreign exchange complex is likely to move away from the dollar. We are seeing dollar weakness everywhere we look, whether it's the European currencies or also the emerging market currencies. And we are quite constructive on EMFX. So across the board, money is flowing out into all these emerging economies that are now benefiting from very low yields. So I do think the inflation trade, or the reflation, as you put it together, reflation trade, as you said, is really coming, and commodities are going to be right front and center of it. Although oil, again, ultimately has a bit of a cap once we get to 60 because of all the spare capacity there is.
Yeah, that's kind of the outlier.
So that's our view.
Outlier on that. Francisco, we really appreciate, we always love talking to you. Francisco Blanch of Bank of America Securities, thanks a lot.